All right. Hi, everyone. Welcome to day 3 of Synergy Traders number 51, Psychology, Discipline, and Time Management 2024 conference. Um, these events are brought to you by TradeOutLoud.com and TimingResearch.com. And of course, these presentations are for educational purposes only. Trading is not suitable for all people. Please consult with a financial advisor and only trade with money you can afford to lose. All of these sessions are being recorded individually and will be on TimingResearch.com permanently for you to review at any time. So today, to open the day, is Price Headley of BigTrends.com, and welcome to him. And I'm going to go ahead and turn it over to him.
Well, thank you, David, and good morning, everybody. Always a pleasure to be with you, and thrilled to kick off day 3 here of what's been, I know, a lot of great speakers and a lot more great speakers, and more importantly, fellow traders to come. With David sharing the topic about psychology, discipline, time management. To me, when I think of that, and it comes to trading, it's all about having a specific, clear, systematic strategy that you can execute easily, right? You don't want to be in the game of like trying to make judgmental, subjective assessments about things all the time, because that will make you not as consistent in being able to not only make your trades, knowing when to get in and even more importantly, when to get out, but also being able to go back and study what's worked and what hasn't worked. So the idea is that, we want to be able to assess how the strategy is working. And when you have a quantitative system in this age of where everybody's talking about AI and technology really driving the train in a lot of different areas going forward, there's never a better time than now to make sure you're getting more systematic in your approach. So I'm going to share with you today my newest system, how you can use weekly options to make what we call quick options doubler opportunities. And they've been doubling a lot of times in a matter of a day or two. So we'll show you how this quick options strategy works and get into some of the system specifics. Can't give it all away, but can certainly get you pointed in the right direction, and then share with you how you can execute those trades consistently via our real-time alert service, where we send out the real-time entries and the real-time exits for you. Just a reminder, as David mentioned, the information provided in today's presentation is based on our proprietary research. It's intended for illustrative purposes only. So what we're talking about today should not be considered specific advisory recommendations. As you know, stock and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or method is not necessarily indicative of its future results. Do see our terms of use on our BigTrends.com homepage for more information here. So what you're going to walk away from my presentation today with is really a deeper understanding and learning my favorite price action pattern. So here we're going to talk about something that involves zero indicators. We're going to talk about trading pure price action patterns today. We're looking for momentum. We're looking for signs that the price action is starting to heat up or starting to break down, where there is likely to be follow through, where there's likely to be a continuation of that momentum, right? For me, I've been trading options for 35 years. I remember I started not long after I graduated from Duke University and had the trading bug where I saw the power of options early on, started April of 1990. So I'm going to share with you a bunch of success stories, chart examples of what works, also when it's not working, what you need to do to cut and run. We call this strategy quick options doublers, because when we can double these short-term weekly options, we take the double and we run. We don't try to trail past 100% gain. We say, look, if you can make that in a day, 2 or 3, then you take it and you move on to the next opportunity. So I'll share with you this newest Big Trends trading strategy and how you can start getting these trades right away. So if you don't know me, like I said, I've been trading 3.5 decades, founded BigTrends.com nearly 25 years ago, November of 1999, because I saw that everybody's talking about just day trading. I was saying, hey, what about quicker swing trades? What about trades that are still working? Why not keep riding those for several days to a week, not just for a day? So our philosophy, like I said at the beginning, is it's all about a systematic, quantitative approach that you can then go back and study how the system is doing. You take your ego out of the game, right? Your ego and my ego, I'll point it at myself. My ego has probably cost me more money, more missed opportunity, more sticking around trades that I shouldn't be sticking around than any other thing in my trading. So for me, I have to get that emotion, get that ego out. And I think it serves you well, also, because when we think about psychology, right, we're talking about psychology, discipline, trade management, the psychology of trading. Why do most traders lose? Just to take a quick aside here, it's basically getting stuck in losing trades too long and letting small losers turn into big losers. Meanwhile, a lot of traders will take small gains thinking, well, you can't go broke taking a profit, is the old Wall Street adage. At least that's what a lot of people tell themselves. But you can do poorly if you take small gains and big losses, right? So we need to flip that around and say, how can we stretch ourselves to get a little more out of the ideas when we're right, or hopefully a lot more, rather than taking 20 or 25% gains in this strategy? I'm taking doubles, 100% gains, and then still getting rid of trades at smaller losses relative to the typical gain, right? So it's about, and then still having a healthy enough win percentage. It doesn't have to be a 90% win percentage. A lot of traders are attracted to that. When you buy options, which is what I'm teaching you here, you shouldn't expect a mega high win rate, but you should expect that you can win a lot bigger than you lose. For me, quick history on my background, I was at Duke University, caught the trading bug, got into a collegiate trading competition, 4-month contest, end of 87, beginning of 88. I'm definitely dating myself. It was right after the 87 historic market crash. And I thought, well, I read about Warren Buffett. I thought, well, I'll take the value buying approach. I remember buying Coke, Gillette, P&G, and getting my statement with a month left to go in this 4-month contest, getting my statement at the end of January, and I had February to go, and said, okay, I'm in the bottom 25% of participants. For whatever reason, that strategy wasn't working. Said, hey, if your strategy is not working after a reasonable enough time, might be time to try something else. And so I'd noticed this pattern of a lot of takeover names being hyped up, and noticed that they would fade back down the next day in a lot of cases. And so said, okay, I'm going to take that strategy, turn it from the bottom quartile to the top 1% in just the final month of the contest. And so realize, hey, if you start finding patterns like this, you can not only repeat those patterns, even though the names are going to change, the patterns remain the same. And this is before computers for me. Now with computers, we can really start to fine tune this to have a lot better results. For me, I became an analyst and then ultimately head of research for, at the time, what was the nation's largest newsletter, options newsletter, in the 90s, but then realized with the birth of the internet, got them in the internet, but basically said, let me go ahead and launch my company, BigTrends.com, after taking a little time off in the early 99 and say, my passion is trading and let's get the word out. And so been blessed to serve so many tens of thousands of folks all over the world with the Big Trends philosophy in these past 25 years and counting. Also put Big Trends on the map with a Barron's feature interview in September of 2000, a year before 9/11, actually, to the day. I said, watch out below. That was not like me. My philosophy through most of the 90s was, hey, everybody else was trying to bet on the downside, remembering the crash of 87 in the 90s. And of course, the 90s kept just ripping to the upside. Then everybody got worried about Y2K, the year 2000 switchover. And so once that was passed, everybody thought, okay, it's safe to buy tech stocks blindly. And tech stocks were getting sold off. And yet people were still way too bullish on them. We were watching the sentiment, that is the emotion of most traders, was to buy the dip in tech in 2000. That was a bad sign. It was a sign that there was way too much optimism and there was a lot more selling to come. As you know, the market's dropped 50% post that, after that Bush Gore election. Hanging Chad got certified in late 2000. Of course, the markets dropped hard in 2001 and 2. Fast forward a few years for me, in 2007, blessed to be inducted in the Traders Hall of Fame by sponsored by Traders Library, and joining a lot of my trading heroes. My goal for you here is to learn from me and the other traders that are to come today, to say, look, learn from what's worked, and then basically get that shortcut to not making those beginner mistakes. The one thing I would ask throughout your day here today is to put your full attention on whatever speaker you're focused on. Don't try to multitask. Multitasking is proven to lower your IQ. Our goal today is to boost your trading IQ, a lot of different strategies. Let's focus on, okay, what's worked for me. So let's kick it off here today with an example on a recent winner, and then I'll go deeper into how the strategy works. So here's one, that we hopped in and then hopped right back out on Spotify, the online streaming music service. Okay, SPOT is the symbol. You can see there was a lot of kind of chop happening in this, and it's not just a breakout trade here, by the way. It's something where we're looking back at multiple days of price action. You can see even before the gap where we got in here, we saw that we were starting to get this series of higher closes. You can see that it actually had a higher close here. These green candles were they're white bars, but finishing near the highs, those are all higher closes here. Okay, so we're looking for a pattern where we're starting to see more and more higher closes building, because a lot of times, again, going back to the psychology of the markets, the first hour of the trading day is often called amateur hour, right? A lot of traders are getting stopped out, flushed out off of the open, gaps that happen off the open, and the people that put their stops in, say, right under the prior day's low or whatever, and then they get whipsawed that next morning with a lower open before it flips back up. The last hour is often where the professionals reside, right? The professionals, the pro traders are saying, okay, well, we're looking to apply capital consistently, but we can see the tone of the market improving into the close. You'll often see that you'll see a market just continue to power up on an upsurge into the close. That's often going to have some upside follow through, or vice versa. When they're starting to sell off into the close, you'll often see some further downside follow through off of that lower close. So we want to watch this day to day. This is a daily chart. We're looking at a trade here where we're picking up that Spotify was breaking out, and actually we weren't early on it. We actually got in the final hour of the trading day here. So you look at this chart here and you say, okay, we're getting in here around just over 290, maybe 292 or so, and we're buying maybe just over 290. We're buying a 287.5 call. And you see what options we're using? We're using weekly options. So every Friday is a weekly expiration for a lot of the bigger options. So week 1 of April was the first Friday's close in April, right? So we look at that and say, okay, we're buying the week 1 options. They were going to expire April 5th, and we're getting into them on April 4th. Now that seems aggressive to a lot of traders I know. Actually, we got on April 3rd. So we got in on a Wednesday before the Friday expiration, Wednesday afternoon, and then we got out Thursday morning. Okay, so we weren't hanging around for even 24 hours in this example. We were able to lock it down. Now notice we bought, when it's just a little over 290, we bought this 287.5 call, 2.5 to 3 points in the money. We paid 382, right? So say it's 3 points in the money, well, then we're paying like an extra $82 out of our 382 is what's called the time risk. That's something we try to minimize by buying them a little more in the money so that we can actually trade them more like a stock substitute for a day or two right before the expiration. The options would expire after the close on at 4 p.m. on that Friday, April the 5th, right? So we're looking to kind of hit it quick, be in, be out. And so the next day when it pops up, you see, we could have made even more in retrospect, but I don't care. You will always be able to find where you could have made more on good trades, right? But it's about catching a sweet spot. For us, if you can get a double in a day or two, you should be more than happy. You should be thrilled with that. And then we want to repeat that pattern as much as we can while reducing risk. So we paid 382. So right away we're thinking, okay, what's a double? If you invest $382 in an option contract, remember one option contract, if you're new to options, controls 100 shares of stock, right? If you were buying 100 shares of Spotify here, it would have cost you over 29 grand. You're controlling $29,000+ of stock for under $400. So 382, we're targeting up near about 765 to 770. We get out at 770. Think about what that means. If you have a right to buy the stock at $287.50, that's what the strike price represents. And you buy a call, that means you got a right to buy the stock at that price. If you're buying a put, it'd be a right to sell it at that price. So the idea is that, okay, I've got a right to buy it at 287.5. Well, to get it up to just under $8, you can see we need to go up into the neighborhood of about 295 to 295.25, where we got out here at 770. Guess what? It went to 304 that next day, right? So that breakout was not too late. It was actually saying there was still more meat on the bone in that upwards momentum kind of rocket launch there. So our objective is target the double. We took it out 101.5%. If you put in $1,000, you couldn't quite get $1,000 invested here, you would only get 2 contracts at $382 a piece. So it would only get you working for about the $770 or so, 765, and then you say, okay, now we're going to turn that into a double $776 profit before commissions. By the way, commissions, small part of the game now. You shouldn't be paying more than $1 a contract with no ticket charges. About 2 contracts in, sold 2 contracts out, at most you would pay $4 round trip in commission, right? So, and if you get active in options, even semi-active, you can cut your commissions down to often as much as half of that. So the beauty of this is that you keep the vast majority of what you make. When I got started trading in 1990, commissions were a lot more expensive, right? So there's never been a better time to trade options than now in my 35 years of trading. So from a cost perspective. Now, we know past performance doesn't guarantee future results. These are past examples. But the idea is that we're going to look for patterns, and we're looking for a build of higher closes coming in. So that's part of it. We'll get into that pattern more. But why are we focused so much on weekly options? Why don't we buy more time? The more time you buy, the more you will pay for the option for the same strike price. And so the idea is that you want to pick your spots, right? Because if you, a great example is if you buy a 3-month or more option, what are you guaranteeing that you're paying for? You're guaranteeing on an individual stock, you're guaranteeing that you're paying for an earnings report. And when there's earnings priced in, that will expand the volatility and thus the premium you have to pay for that option. We're looking to navigate around those excessive premiums and say, look, we're not going to be in for the earnings. We're going to be in and out before the earnings, or if it just reported earnings, we'll be in and out before the next one. So the idea is that let's take advantage of a shorter window. And so the beauty of this is that we can use this not just for bigger accounts. That one would obviously cost you just under $400 to control at least 100 shares of stock on the option contract. But our average contract price has actually been under $2 or $200 a contract year to date so far here in 2024. So these same week options are going to give us what we think are the ideal kind of sweet spot leverage to catch a 1 to 2 day move and basically be in, be out. So what if we haven't hit our target profit by the expiration? We will get out at the latest an hour before the expiration on the Friday at 3 p.m. Okay, that would be the absolute latest. But the key here is that since we're using a daily chart, not an intraday chart, we want to make sure that the daily chart is giving us our signal near the end of the trading day. So we will usually send our trades between about 3 and 3:30, no later than 3:45 Eastern Wall Street time, an hour to as close as 15 minutes before the close. So when it's usually 30 to 60 minutes before the close, that's plenty of time to get your trade on before the market's bell rings at 4 o'clock Eastern. And so the idea is that you're getting a real-time email with our quick options doublers, and we're going to also recommend that you get the WhatsApp update to your smartphone also included, which is just all part of the recommendation here to say, let's make sure that you're not missing any trade that we call out when to get in, and then we'll follow up with when to get out as well. So using the daily chart allows us to minimize our fake outs. We can't get rid of all of them. You're going to occasionally get faked, but you want to reduce as much of the fake out potential as possible, cutting down on the quote market noise, right? As a trend trader, noise is your biggest enemy, right? You're looking for clarity. I'd rather trade less situations with a higher quality, lower noise ratio than more situations that are going to potentially noise me out, because I not only want to recommend that you protect your capital, your financial capital, but I'm going to call it your psychological capital, your confidence. Your psychology and your confidence must be protected at all costs, right? It's better to not trade than to damage your trading psychology, because the idea is that you want to get yourself into that mode where you're like, yeah, when I get one of these ideal kind of setups, I'm ready to fire. I'm not second guessing. I'm not afraid of pulling the trigger. If you're afraid of pulling the trigger, it's probably because you have some kind of scar tissue from past trades that went wrong, right? It happens. And so the way that you minimize that is you get yourself back in the game on a small scale, and you get into the habit of executing whatever methodology you're working on consistently, right? So you say, okay, I'm not going to second guess this trade over the next trade or the last trade. I'm going to say, I'm just going to execute that consistently. And that's why we recommend starting small and building. So you build the habit of regular and continuous execution. When it's time to get in, when it's time to get out, you pull the trigger consistently. You don't second guess yourself or your system. The other thing we do is we call it profit factor filtering. What does that mean? It means that basically we look at what's called the profit factor, which is saying how much has this system won and lost on a given stock signal that we're looking at. And also, just as important as the winning percentage, is how big does it win? How hopefully relatively small does it lose compared to how big it wins? That ratio, average size of win to loss, is just as important as win rate, because you can have a middling win rate, but if you win 3 times as big as you lose, then you know what, you can have a below 50% win rate and still make a lot of money in option trading with a good average win to loss ratio. So it's important to realize that a lot of traders just ask me, what's your win rate? And I'm like saying that's only part of the equation here. Okay. So this profit factor filtering, we're looking back a lot of times 10 years plus on the history of how these stocks have performed with this particular system for our quick options doublers approach. So the idea is that we want to make sure that we have that history on our side. Going back and having history on our side does not guarantee that your next trade is going to be a winner. You are playing a probability game as a trader and investor, right? Probability games meaning that, okay, you put the odds in your favor, not just on win rate, but on size of win to loss. Your profit factors in your favor. And for us, it's not just that it's a little bit better than a coin flip. It's got to be meaningfully better. So you overcome what's called slippage, which is how much it costs you to get in and get out. That's part of trend trading, right? Is you might have to pay a little bit more on the way in or take a little bit less on the way out sometimes. And so you can still easily overcome that when you catch these runners, these trades that just keep on running, kind of like the Energizer Bunny, right? They just keep going and going and going. That's our objective, is that when you get those doublers will basically make up for the occasional stop out or the occasional trade that didn't fire like you thought it would. So that gives us opportunity to trade a wide variety of stocks, not just big tech. Okay, so we'll focus on a lot of different sectors and individual stocks that are leading in the major setups. So the price action pattern that we're looking for here, let's get a little more specific about this. We're looking at consecutive higher closes for long or bullish buying a call trade. Okay, so that means we're looking for not just that this close is above the yesterday's close, but we're looking for back-to-back higher closes for starters. We're also looking for back-to-back green bars for long signals. What does that mean? Remember I showed you before, it means that we're closing above where we opened for bullish signals, back-to-back, 2 days in a row. And for the consecutive higher closes, we're actually looking for at least 3 consecutive higher closes. So we're looking for a lot of building positive momentum, and it's the opposite for bearish trades, right? We're looking for building negative momentum where the bottom's starting to fall out for potential to make some money on some puts fairly quickly. Now, the exact settings that we give you are proprietary. You get those when you become a subscriber, but I'm going to show you more trade examples so you can start to visualize this. But first, saying why should you care when you go back over time? Going back to all the trades that we both tested and traded, you can see here that this takes it all the way back to the beginning of 2020. Now, I'm always hesitant to show, the big numbers and kind of create the stars in your eyes without reminding you that past performance does not guarantee future results. Just because a system is working does not mean you should load the boat on the next trade. Start small and let the system prove it to you. I'll give you a way to start to kind of test it out here later. But the idea is, okay, since inception, a $5,000 account grew to over $28,000 for a profit of $23,460. That's a gross profit that adds up all the winners and the losers if you put in up to $1,000 on each trade without any compounding, and it's before commissions and before subscription investment. So we know that we can't guarantee future results. Future results will vary. The past never guarantees the future, but we're looking for these patterns, right? So the names are going to change, but what remains consistent for us is the consistent execution to trade the system exactly how it says when to buy and when to sell once we've run it through those historical profit factor results. So the idea is that, okay, you say, look, you can even take a smaller $5,000 account and grow it very healthily through a lot of challenging conditions, right? That 2020 look back includes COVID. It includes the bear market of 22, includes the run-ups last year with some of the volatility in between and this year. So, but let's just look at some more trade charts because the picture's worth 1,000 words on the chart, right? Amazon. Now, this is an interesting one because you can see that it doesn't look like it was that much momentum when we got in here. But remember what I said, there's the two green closes. There's the first close here and then the second close when we're getting in. Those are the higher closes over where they open. But the other important, the third bar back, you can see there's just a slightly higher close than where we closed the bar before here, right? So you actually have had 3 higher closes. So we're saying in that last hour, this is going to meet our criteria. Stocks trading near 178. Now we're buying just slightly in the money. In this case, we're buying the 177.5 call. They're going to expire. That was happening on March 20th. They're going to hit their expiration on March 22nd. So we've got like 2 full days to go before these options would expire. Now think about this. If you buy a 177.5 call, we paid $1.85 for it. So if you're putting in $1,000, that means each contract controls 100 shares for $185, right? 100 shares of stock would cost you about $17,800. So it's almost 100 to 1 theoretical leverage, right? You look at that and you say, well, we're buying on $1,000, we can get 5 of those for just under $200 a piece, and we're going to be in for like $925. Now you buy 5 contracts for $925. What do we need to happen? We need that $1.85, $185 to go to $370. That's the double target. So we're putting an order out there right away to say, okay, in at $1.85, we're going to exit at 370. And when we get that, we're going to exit all 5 of our contracts in this example. So you look at that and you say, okay, the next, what do we need to get to? Take 370, add it on top of the 177.5 strike price. And it's saying that you need to get up to about 181.20. Now look at the high on the day, the next day for Amazon was 181.42, right? So we got past our intrinsic value target, and you probably wouldn't have to get to exactly 181.20 because it still had almost 2 days, a day and a half to go when we're getting our target. So there's going to be some time value still in that option. So probably just a little under 181 is where you're going to really get filled at the 370. But you can see even on intrinsic, even if it was the final day, you're getting there. And then the key is you book them. You book them, Dano. You say, take that money and run, because look what happens. If you hold and hope that's going to keep blasting to the moon, it reverses back down. And actually by the close, you see it finishes back near where you got in, back near 178. So if it finishes at 178 at expiration the next day on March 22nd, what's that option worth at 178 at the expiration? It's worth a measly $0.50, 50 cents, right? So you could turn a nice winning methodology here and winning example of a double into a big loss if you're not careful, right? So you've got to be strategic about this. We'll also guide you if we think there's a right time to go ahead and say, let's go ahead and trail the stop, tighten it up. We try not to do that too much, but if we are concerned about a lost momentum getting close to the expiration, we'll guide you how to limit your risk so you don't see too much of a give back after you've had a healthy profit. But you can see here, Shopify actually just had some bad news yesterday. The stock gapped way down. This is a February example. So you can see here that this is back on February 7th. And remember, the same kind of thing we're talking about here. So look at how interesting this one is. When you go back and look at the prior closes, you say, well, that's a red candle. Isn't that not very inspiring? It's a red candle, but it is a close. As we go back and look here, where we're looking at, okay, we've seen some higher closes. We're getting the positive momentum turn here. You see kind of this reversal by the end of the day. It's kind of crunch time here, but it gets the positive green reversal on that bar, the little J hook there, if you will. And then the second bar we're getting in right near the end of the day. Stock's just over $85. We're buying the 85 calls. These options were gonna expire here on February the 9th. So again, we got in on a Wednesday afternoon, a couple days before the expiration, February 7th. We paid $1.47. You can see here that stock went ballistic the next day, right? We only needed it to get to about $3. 294 was our target, just under $88 intrinsically. And look what happens. It gets up to 91 and change the next day, right? So we're actually cashing out somewhere in this area here way in advance of that high, but it's because we don't want to leave that money on the table, right? So it's our objective is to say, let's be careful about holding and hoping. Let's say we'll take that double, make the $882 on a maximum of $1,000 invested, which in this case we couldn't get 1,000, we got 882 invested, made 882 again before commission. But you see that, what would you get? How many contracts you would get? You can see in the neighborhood here of about, can't quite get 7, so we get 6 contracts in for $1.47 a piece. $882 invested. So you see the option move like $1.50 almost, right? $1.47. And you would think, well, does that mean the stock moves $1.50? No, it needs to move a little more than that. It needs to move up almost $3. So that's about we would call a 50% delta at first, meaning that your option is only going up about half of what the stock's going up. That's still tremendous leverage, right? Because if you bought the shares, you would pay $8,500 for 100 shares. We're controlling $8,500 for just $147, right? So that's where the leverage of options really kicks in. You do have that time risk, since most of what we bought here was mostly time, of saying, okay, we've got to control that. So we've got to talk about how we're going to manage the losses. What's our losing stop going to be? Our stop loss is a 50% stop loss. We're targeting 100% gain, so a 50% loss seems like a lot for a lot of traders, but let's face it, these options can be volatile, especially when you're buying a lot of time premium, right? So here's another Shopify example that didn't work, right? We saw the breakout here. Looks like we're getting a really positive surge into the close. So our entry here is happening just above 81. We're buying the 81 calls. We're paying $1.41. Pretty similar to the last example, right? In that you're paying almost $1.50. You're expecting it to go to almost $3. 282 would have been our target. And you see that next day, it got up here just over 83, right? So maybe 83, 83 and a half. We're up to maybe $2, 2.25 intrinsically. Didn't get to 282. And then you see it starts coming back down, and it happened so fast that we actually didn't raise our stop. We said, okay, well, that's just still bumping around. See if we can get there. It couldn't. And we took the 50%, actually 50.35% loss, which cost us $497. So the idea here is that, okay, if you get, in this case, you can get almost your full $1,000 invested here. You can get 7 contracts in for like $987, right? So you see that you're losing $497, about half your investment, and you're saying, okay, well, that's going to happen sometimes. But my philosophy is, if I can lose 500, then make 1,000, then lose 500, then make 1,000, give or take, that's still a pretty healthy ratio where you'd be averaging about a $500 gain over each 2 trades if you can do that consecutively. When you hit your target, then hit your stop, hit your target, then hit your stop. So the idea is that can stack in your favor over time if that pattern continues. Again, we can't guarantee future results, but the idea is that we're going to always look to control risk. If it loses half, that's where we say uncle, and we move on. So, philosophically, of course, we've talked about some call trades. You got to know you can also make money in down markets. So we will trade put options, and we will typically hold them no more than the 3 full days. And if it hits what we call our time stop on that expiration day, the final hour of the trading of these options, then we will say it's time to get out at 3 p.m. We'll send you a reminder email and say, okay, let's go ahead and cut this trade out. It needs to go because the expiration is upon us, right? So this one happened actually right before Thanksgiving. This was a Starbucks put example. So you can see, look at the difference. Now you're getting the lower closes, so we've had 1 lower close here, then 2 lower closes, then 3 lower closes. Of course, they're all red candles, meaning that we're closing below where we open. So it checks that 2 red candles in a row criteria as well. And you see that the stock was finishing there near 104. So we bought the 105 put. So they're about $1 in the money here. And we only paid like $1.52. So if you pay about $1 in the money and you pay about $1.50, about 1/3 of your premium is time risk. About 2/3 of your premium is what's called intrinsic value, meaning that if it doesn't do anything, you at least retain that $1 of your $1.50 as the intrinsic portion. Of course, you've always got price risk, right? So we still have to monitor that too. But you see that next day it dips a little bit towards 103.5. Then on the expiration day on the 24th after Thanksgiving, where the market was closed on that Thursday, and we got in on a Tuesday afternoon, then held it Wednesday, no trading Thursday, then Friday. So only in it those into the expiration here, and you see it's closing down here near 102.75. So we're getting out here at $2.35. So that would be the equivalent of like 102.65. And you see that we're getting a 54.6% gain on $1,000 invested. Of course, didn't quite get the 1,000 here on a $1.52. That would get you 6 contracts in for like $912. You make $498, just over 50% gain. So not bad for a couple of full trading days of work, right? With the Thanksgiving holiday in between. So, the idea is that, okay, if it's not getting to our profit target, but it's not getting to our stop, let's give it a chance to run until we get to an hour before the expiration, right? We don't want to mess around with that final hour of an expiration day. Try to reduce that volatility and also give you plenty of time to get out and not worry about it. Now, sometimes you get lucky and a trade will gap past your 100% profit target, right? So, sometimes you can have a gap against your 50% stop too. You've got to figure that those gaps are going to kind of work their way through. But the thing I love about buying options is what's called the asymmetric leverage, which that's a technical term for meaning that you can just win bigger than what your maximum risk is, right? In theory, the worst you could ever lose in an option purchase is what you put into the option, right? Which is a theoretical 100% loss. So if you lose 50% of your stop, well, then if it gets worse, you can only lose that other 50%. But the idea, we obviously want to minimize that. But on the other side, saying, sometimes it could gap way past your double target to a triple or better. In this case, it was just a gap to 138% and change on a PepsiCo put. So Pepsi, you can see it was, and we weren't early here, right? You can see a lot of people want to pick that exact high coming right off of that 196 and change top and say, oh, I called the high. I would never try to do that. That's basically a game. I remember seeing John Bollinger at a market technicians conference who said that his mentor told him that he was only allowed to pick the exact top and the exact bottom of a market once in his trading career. And John figured out that wasn't very good odds. Let's not play that game, right? So I thought that was a good reminder from another trading legend that, look, let's focus on the sweet spot. Where is the easier money to be made in the middle of the trend, maybe even towards the latter part of the trend, where the momentum kind of accelerates, right? Picks up. So in this case, Pepsi's already broken down hard that prior big red candle before, right? And you can see there's the 1 and the 2 red candles coming in, even the third red candle here, and the lower close is working for us here. So we're actually getting in here. You would say, gee, that looks late, about 186 and a half. We're buying a little bit out of the money in this case. We're buying the 185 puts, stocks trading, or the options trading at $1.06. This was kicking in on a Tuesday, actually. So this is a Tuesday afternoon, a little bit more time here. So that's why I had to go a little bit with the out of the money versus the in the money. We felt that was a better choice. And so that $1.06, next day we're making some money. It's gone from 186 and change down to 185. And then the following day is where we get the gap in our favor that goes beyond our double target. Remember, if you bought a 185 put, it goes below 183, then of course, and that's still got another day to go before its expiration on May 25th. It's going to expire the next day, May 26th. But bottom line is that we're getting out at 253 beyond our $2.12 100% profit target. We made 138%. So again, if you were buying up to $1,000 worth, you could get 9 contracts in for $954, and you're turning that 954 into 1,323 gross. So that's where that bigger than 100% profit can happen. Again, past performance never guarantees the future results. But, again, just from a reminder about overall performance, right? Again, through all kinds of different market environments. That's the key here, is that the beauty of this approach too is that you don't have to make an assessment about should you buy and hold the broader market here, right? There's going to be a bull market and a bear market somewhere just about all the time. Obviously, we kind of like to align ourselves with where the momentum has been. Obviously, this year it's been a better market for bullish trades than bearish trades. So we're going to, in all likelihood, get more bull signals in bull markets and more bear signals in bear markets. But we'll still see opportunities on both sides throughout different market conditions. So we're going to take the one that gives us the best historical profit factor. Like we said, that's where we're running a lot of extra data. We're not just blindly taking every trade that gives us setup. We're saying, look, it's got to have worked enough in the past to give us what we feel is a meaningful edge. You can see the edge is substantial when you start stacking it through the bear markets. Remember, from the 2022 start of the year when the market dropped, a lot of the big NASDAQ stocks got knocked down like 30+%. The S&P was down like 18.5%. And then when it came back last year, the S&P just came back to where it started 22, right? So it did like a round trip and was basically about flat over 2 years. In the meantime, you could be making a lot of quick ins, quick outs, and not having to just buy and hold through down markets as well to try to make it back up later, right? So the idea is that by hitting it quick, getting in, getting out, we think that there's a lot more opportunity, and you can reduce your risk of not having to hold the market all the time, right? So while past performance never guarantees future results, you can see $5,000 account grew to over 28,000, adding up all winners and losers before commissions, before subscription investment. So gross profit of more than 23 grand in that look back period, including those bearish phases like COVID and the 2022 bear market. So the beauty of this too is that we don't compound this result. We could show it even bigger, but we're saying, look, just stick with the up to and no more than $1,000 a trade. And if that's too much for you, then, you could get one contract at a time for $200 or $300, so the idea is that, you can try it out with a small amount and then grow it from there. You can see the strategy has been really powerful, and we've been really happy with it for our traders that want quicker in and outs and still not have to worry about screen watching all day, right? This is something where that we're just going to get the signal in the last hour, and that we're going to guide you through specifically with real-time updates when it's time to exit, or where to put your stop, where to put your target, that kind of stuff. We'll guide you through all that specificity, never leave you hanging. So to celebrate this methodology and its success, I'm offering Synergy traders here today a truly exclusive package I've never offered before, and that is we're going to do something which includes both the trade alerts and the some follow-on education. So instead of having you buy a longer subscription, I'm saying just try it for the next 3 months. So don't look at this as a get rich quick. Don't look at it. You shouldn't look at any of these things that people are talking about as expecting immediate results. Look at it as like apply a steady, slow amount of capital, and then get comfortable with how the trade work, how the system works when it works, and how it also works when the trade is not going in your favor, right? So, but what we do is when you become a subscriber, we give you a lot of the insight, right? It's not a black box system. We will give you the specific settings and rules to the quick options doubler system. So you could actually follow it yourself, or certainly at least see what we're looking at when we call out a new trade and know exactly what we're looking for. That's valuable in and of itself for those who want to kind of help build their own system around their methodology. So we'll essentially help teach you how to trade this as well with weekly video training that I give you every Monday at 6 p.m. in your member site access. So when you become a member, even for the 3-month trial, you're going to get all of this that even a longer term subscriber would get. Also, you get access to me and my analyst team. If you've got any questions about a trade that we called out, something's not clear to you, you can always shoot us an email with a dedicated email for our paid customers. This would usually be $891 total cost off of my bigtrends.com website, $297 a month times 3 months. And then all the other support, even more valuable. But for Synergy traders, I'm going to actually cut this down dramatically here. I'm going to say you're going to get the 3 months of the trade alerts from our service that we call quick options doublers. You're going to get the 3 educational trading resources, which includes access to me and my analyst team, which includes the rule sheet to know exactly what you're trading, and then of course the weekly follow along training going forward, all in just $177. So to me, like I showed you, the value of, even if you're trading one contract at a time and you double, on a few $100s invested, make a few $100, you can easily pay for this off of one winning trade. So what I did is my team, I'm all about the KISS principle, the keep it simple principle of just let's keep it simple with this order page here. So we set up this page for you, members.bigtrends.com. It's not a WW page, mind you. It's members.bigtrends.com /quick. Quick, right? Because we're looking for those quick profit opportunities. And so when you pop that page, then it'll look like this. It's really simple. Let me just show you what it looks like here, because I'm all about making it incredibly simple. Okay, so you're going to get not just the access to the 3 months of trade alerts, right? And you say, well, how many trade alerts can you expect in 3 months? So over about 13 weeks, I would expect you get at least 13 trades, and sometimes you might even get a more than a trade a week, but at least the 13 trades. And more importantly, like I said, you're getting the support as well. You're getting the rule sheet. You're getting the detailed education of what's behind the system when you go into our member site page. So this is, of course, a secure page. We're on our 25th year serving big trends clients, so nothing to worry about there. There's no other promo code discounts. I've taken it down as low as I can from just about $900 value to or more with all the educational support to just $177. So all you have to do is, if you scroll down, you see we've got a PayPal link there, or you can put your credit card info in on that secure page. Make sure you get your billing info in. We get people that maybe have their credit card bill sent to a different spot than their home address. So make sure you get the right billing address information in there. Of course, make sure your email is in there too, right? Your email is so important, right? So double check your email when you pop it in there, because that's going to be the first way that you're getting your welcome information sent to you, as well as, of course, the trade alerts. But then also, we'll follow up with you as a new Quick Options Doubler subscriber with the WhatsApp instructions to your email address as well. So you make sure that you can also get that on your smartphone at no additional charge here via WhatsApp. So bottom line is at $177, like I said, gets you all that access and all that education to go with the specificity of exactly when to get in based on our Quick Options Doubler system, and then exactly when to get out. If you've got questions on it, of course, you can email us through clientcare@bigtrends.com, or you can call our toll-free number here, 800-244-8736. If you can't remember that later, remember it's just 1-800-BIG-TRENDS. That gets you to us with any questions you have toll-free. We've got representatives standing by all the time throughout business hours here on the East Coast. We're based in Kentucky, but still Eastern time here. But the bottom line is that, we talk about psychology. We talk about the importance of following a system, right? So when you think about what you're also buying, is you're buying into the concept here that a system will help you a lot more than trying to be seat of the pants and trying to handpick this stuff out just subjectively on your own, and then not being a consistent executor of your plan, right? It's about, what I tell a lot of people that have their own trading account, and they're saying, hey, everybody's talking about financial freedom, that, hey, everybody wants financial freedom, and trading certainly embodies that, right? But with that freedom becomes responsibility, comes the accountability you have. So you're not just the owner of your trading account, you're also the key employee in your trading account in terms of executing a system and a methodology that's going to get you to your goals. And a lot of times what I remind people too is that your goal should not just be about making money. Your goal should be about expanding your awareness of what you see in the markets, of educating yourself on an ongoing basis, right? So that's why when I founded Big Trends nearly 25 years ago, my first kind of core principle was that we're going to educate traders. We're going to take the veil off. We're not going to black box everything. We're going to focus on really being very open to our paid subscribers about what the system's doing, how it's doing it, what the rules are for getting in, what the rules are for getting out, right? So when we have the Spotify trade as an example, you see that was just a month ago or so, where you look at this and say, okay, April 3rd, we're seeing the building of some support. You say, well, gee, it sure didn't look like it was really getting ready to go. But when it did start to break out, we're saying, hey, it's already checked the boxes here. If that breakout had come when we got in here, remember we got in back here when the stock's just over 290-ish. And we said, if it was just breaking out when it had come off of these prior negative candles, we would have needed more follow through. And so that was already building the support here, was checking the boxes before the breakout so that we could actually check the box when it did follow through and break out. So the important point here is that, we're looking at that building of momentum, looking for, okay, how you can start to say this thing's ready to go. If it's not ready to go, don't trade it, right? Don't try to say I'm getting in before everybody else if it doesn't check the boxes. We have a lot of clients who have been like pilots or engineers who are used to having checklists for the work that they do, right? If you wouldn't want a pilot who didn't check off all the different key things that need to be right before your plane launches, right? If they miss something and the plane doesn't launch successfully, you got a big problem, right? It's kind of the same way with trading, right? You don't want to be getting into trades prematurely without having checked all the boxes that it indeed is worth saying it should be now launching successfully, and saying, okay, we've got a plan for if it doesn't continue, how to get out. But of course, the ones that keep on going are the ones that are going to carry you to your growth goals, and then controlling your risk when it's not. Knowing that, of course, it's all about following a systematic, repeatable approach. Then we get back to the whole topic of today, which is about that psychology, that discipline, that proper trade management of saying, you know what, the system's got to be the bedrock of all of that, right? If you have that system supporting you, then basically you're going to be in the position of saying, I can execute that. I can handle when we say to buy these calls, we'll tell you to buy them up to a certain price, right? So if we said something like buy it up to $4 or whatever it was, I'm going to actually pull it up and show you exactly what it looked like when the email was called out here. So when you look at this and you say, okay, we call out that trade, and I'm going to go back to my emails here back in April here and say, okay, and you say, okay, for quick options doublers, we're looking for that that exact specificity, right? We're going to say, okay, here we go. So pull that in and say, okay, we're going back to, where'd that go? It just disappeared on me. We're going back here and saying, okay, you know what? It's all about, quick options doubler. So type the whole word in there and say, okay, you know what? Like we said, not everyone's going to work. When they do work, obviously those are the ones that carry you. And then you say, okay, we're really looking for that kind of speed of movement. And so it's all about saying, okay, yeah, let's put those odds in our favor and really zero in on the best of the best. There we go. Scroll it back down now. So remember, that was back on April the 3rd. So you look at it here and you say, okay, yeah, it was popping there. We were just launching. And so we walk you through exactly, when to get in, when to get out on every single trade, right? So just whatever we would call out here, like here was one that we called out a couple more to show you a past example. These are not trades now, right? We're already out of these, but you see, look at where that came in. It came in here 3:21 p.m. Okay, so you're going to expect that. Okay, and we had 2 trades at that point. So we're getting into 2 different call positions. There were both options that were going to expire on that Friday, April the 26th, now passed. And we're saying, okay, look, we like them both and we're buying them both at 60 cents or less, right? So those are really cheap, right? So you can see that, and that both of them don't have to fire. If we get one of them that doubles, one that has this 50% stop, that would still be a successful pair to do, right? So it's going to be all about putting those odds in your favor and knowing we'll guide you through when to get in, when to get out, right? So when we do that, we'll be able to tell you, okay, exactly where we want to follow along and make sure that you're following along, able to easily execute consistently, right? So you look at the long-term history again, back to the beginning of 2020, right? We said through COVID, through all of the different environments that we've had in these markets in recent years, and it's been driving folks successfully through a variety of different market conditions. That's the past. We can't guarantee the future. Future results are going to vary. It could vary worse. It could vary better, right? The idea is that be consistent, discipline and execution, and focusing on just following the same capital allocation consistently over time will prevent you from getting too high or too low, will build your confidence in your ability to execute, and will allow you to follow a system that's guided folks through successfully here, looking back over these past almost 5 years, right? So like I said, just a reminder on the offer real quick, is that we're going to use not just a longer term subscription. I'm a believer that when you see what this can do for you over the next 90 days, you'll want to pay closer to retail price, because you'll realize that you can easily get your money back even at a higher price level because of the speed of return, not to mention the guidance that we give you through all this, knowing that every trade involves risk. You got to always keep that risk in mind. Risk management is so important to keep you in the game for the long haul, right? 3 months of trade alerts plus the 3 educational trading resources. Remember, we said you're going to get my rules sheet with exactly what this system is driven by for rules on the bullish trades and rules on the bearish trades, and also, of course, exit rules. In addition, we're going to guide you through with anytime you got a question, you can reach me and my analyst team. And I'm going to give you weekly video training with hey, what worked for us this past week? What are we looking for on the markets this coming week? Every Monday after the close, that'll be in your member site access. You get a lot of educational value to go with the trade alert call outs in real time. Where you go is members.bigtrends.com/quick. And that's really your guide to make sure you're taking full advantage of this. And just, you see, we're scratching out the 891. We're taking it down to just $177 for the next 3 months of access. Like we said, over the next 13 weeks, we expect to get you at least 13 trades, probably more. More importantly, though, really start positioning you for taking advantage of a systematic way to take money out of the markets and control your risk. So when it's not working, cut and run. When it is working, you get the bigger gain opportunity with the quick options doubler program. So let me see if we've had any questions here before I hand it back over to David. Let me see if I can expand my Zoom box there, and or maybe David, you might, I'm not seeing it, so maybe you might help me if we've had any questions. Be happy to answer
Alt
those.
H is the easiest way to pull up the
Oh, there we go.
chat.
Okay, I see it. So Terry, thank you, David. I see Terry W said, do you do a lot of options at $1 or less? Because I showed you those couple that were on Bank America and Marathon. It can happen, Terry. It's not the requirement, right? Sometimes if you're trading a $2 or $3 option, you say, oh, it's $200 or $300 a contract, but it might be on a stock that's $100, $200, $250 or so. You know, obviously I showed you Amazon, right? It was $178. So the key is that you got to look at it as relative to what you'd pay for the stock. Even one contract, even if you only traded one contract, that Amazon example was like 100-to-1 leverage because we paid, as we showed you, under a couple $100, and the stock would have cost you like 18 grand, right? So the leverage potential here is tremendous. Ann asks, can I join with a small account of 10,000? Absolutely, Ann. We showed you examples earlier where it was just showing on a $5,000 starter account. So we get a lot of folks that start in that $5,000 to $10,000 range, and then as they grow their portfolio, they scale up a little bit in their allocation. So one advice I have about scaling up your allocations as you're seeing success with the service is don't go hog wild as you scale up, right? Give it a chance to show you what it can do through both the good cycles and through the occasional stop outs, and say, then I can gradually scale up. So rather than like instantly doubling your allocation per trade, I'd say kind of ease into scaling up. Don't just go all hog wild from say you're putting $1,000 in a trade and say, now I'm going to put 2,000 or 3,000 into a trade. To me, that'd be too much of a jump. Rather see you kind of easing your way up in your allocations as you build it up. And Ann mentions only about a year of experience and trying to add to her existing income. We get a lot of traders who are looking to supplement income. And so that's a very good point, Ann, is that, you know, you can do this easily with an existing day job, because we're not going to require you to screen watch. We're going to say, you know, you're going to get your trades in the final hour of a trading day. We've got our email and our 800 Big Trends line. If you've got a question about, if you worry you missed a trade or something, you can reach out to us, but you'll get that clear email and with the WhatsApp reminder on your smartphone. It makes it incredibly simple and easy here. I do want to recommend you stick around throughout the entire day, including the next hour. My good friend Norm Hallett, you definitely want to stick around for Norm. He's a great speaker and fellow trader and has tons of experience to share with you as well. So definitely stick around, and good to see you as well, Norm. So bottom line is that it's all about taking action. If you're going to be successful, you must execute. And the execution I'm suggesting for you now is go to that page while we're waiting for getting started for our next one. You could go to members.bigtrends.com/quick. Thank you, David, for posting that. That's a link in there that you can click on that should pop you right to that order page. It's quick, it's simple, it's easy to go ahead and get started. And we're here for you. Like I said, on our 25th year serving our Big Trends community, a lot of you that I see in here to thank that have been part of our Big Trends community for a long time. So